What is going on, traders? Are you guys ready for a volatile April in the stock market? Well, you're probably going to get it. The next couple of weeks are going to be some of the most volatile weeks in the stock market and will definitely set the tone for what happens for the rest of 2022. The next few weeks will be some of the most important weeks for the entire year because it will set the tone for what is to come. Allow me to dive in further and explain to you because it will matter if you care about your portfolio, your investments, and your trades. First things first, the consumer price index. The theme of the last couple of years has been inflation. How will the Fed fight inflation? The Fed first kept telling us that inflation was transitory, and then they said that it would naturally decline on its own. And now they are admitting that they have to be aggressive in order to combat the highest inflation that we've seen in 40 years. Well, on April 12th, 2022, we are going to get the CPI numbers at 8:30 a.m. Eastern Time. This is the consumer price index that tells us how bad inflation gets year over year, month over month. During the last CPI reading, we saw that inflation is almost at 8% year over year, 7.9% to be exact. And in February alone, the price index for all urban consumers rose 0.8%. Now, here's what I'm looking at. If the CPI numbers for March, because the March numbers are released in April, come in even just a hair lower than expected, then you can expect the markets, along with if mega cap companies report good earnings, which we will get into earnings in a second, you can expect the markets to likely get back to all-time highs. Now, we know that it is probably unlikely that March inflation is going to be lower than expected because we saw the price of all commodities rise, especially oil, lumber, wheat, etc., rise astronomically in the month of March due in large part to the geopolitical conflict that we have in Ukraine and Russia. We also have the Fed Watch tool. This is the prediction by the Fed members of what the rate hikes will look like. For the next FOMC meeting on May 4th, most of the Fed members are now projecting almost an 80% chance that we will get to a 75 to 100 basis point Fed funds rate by May 4th. That means that 80% of the Fed members are expecting that the Fed will raise rates by at least 50 basis points, could even be 75 basis points, although I personally don't think it'll be 75. It will likely be 50, and I don't think we will get a 25 basis point raise unless miraculously the CPI numbers are way lower than expected, which is implausible, maybe even impossible. Now, here's the good news is that UBS predicts that inflation has peaked. Now, just because inflation has peaked or they're projecting that inflation has peaked does not mean that it won't continue to be a problem. If it is 8% year over year, or as UBS estimates it coming in at 8.5% year over year, it can stay within that range for a while. It doesn't mean the prices will drop. It just means that the prices have likely hit a ceiling or thereabouts. If inflation comes in at 8.5% year over year, that will be the highest reading since December 1981. Almost a 41-year high. Now, one thing that I respect about UBS's forecast is if you look at their numbers are usually above consensus expectations for Wall Street. They don't underestimate the inflation readings, and they've been right so far, even when the Fed was saying that inflation was transitory and that inflation wouldn't go up drastically. UBS was saying otherwise. So they do have a great track record with projecting what the inflation numbers will be, even if they come in slightly higher than normal most of the time. So the question is going to be how much of that is priced in. That is always a question when it comes to the market because the stock market is forward looking and a lot of this is likely already priced in, but how much of it is priced in? Is 8.5 priced in? Like if the reading comes in at 8.5% year over year, would that be priced in or would that tank the markets? Well, in my view, I think it would be rather expected, especially since the Fed is targeting an 80% almost probability of a 75 to 100 basis point Fed funds rate. Now, if it comes in significantly higher than this, then I think you can start planning for the recession pretty early on. At that point, you're going to have to start comparing our situation to what was going on in the 1980s. And we will likely have to summon the spirit of Paul Volcker to come in and start raising the Fed funds rate aggressively as well as selling assets off of the Fed balance sheet. And that will definitely start pushing us into a recession. So you definitely want to keep your ears and eyes perked up for what is to come April 12th. Of course, we will be following it. I will be streaming it most likely, but we'll be following it in the Discord as well. I'll be giving you my stock market analysis as always, as well as my hedges in real time. and the options day trades, which we do every single day on the channel, on the Discord group, where we wake up neutral and pick either calls or puts depending on the price level and the price action that goes on that day. And I will likely be hedging using the VIX or some form of index option or futures as well. So if you want access to all of that, come join the group, be a part of the community. It is a very valuable community with thousands of traders. There are so many valuable resources here on the Discord, including a bot that tracks large options orders, dark pool orders, and options trade bot that gives you a % confidence that the options play will play out, a scalps bot, stock breakouts showing what patterns are currently in play and whether there are breakouts of those patterns, upgrades, downgrades. We have a beginner question section where you can ask our coaches any beginner's question you want, whether it relates to stocks, options, crypto, etc. And we recently upgraded our beginner's education section. We will continue to add to this: how to read a financial statement, how to research a stock, stock market glossary, how to value stock. We will be adding candlestick patterns, chart patterns, etc. to this as time moves along. So if you want to learn how to play these important announcements, how to hedge, how to protect your portfolio, come join the group. Would love to have you. Okay, and the next important thing that will define April 2022 as well as the rest of the year is what goes on with the first official earnings season for 2022. Obviously, we had earnings in January and February, but those were reflective of Q4 2021. Upcoming is the first earnings season for 2022 numbers. We want to see how companies are operating in this new inflationary landscape of high prices, high input prices, and limited supply. Up first, we have the major banks reporting earnings with JPM, BlackRock, Wells Fargo, US Bank, etc. That is going to be very telling, especially since the spread between the 10-year and the 2-year has inverted to the lowest point since 2019. Actually, this is even lower than 2019. We got to minus 0.04 in the spread between the 10-year and the 2-year. Actually went all the way down to minus 0.09. It flashed to minus 0.09. Now, what this simply means is that the difference between the 10-year yield and the 2-year yield is that the 2-year yield is now paying higher than the 10-year yield, right? Or at least it does in flashes. And that happens because investors are so worried about inflation, they are not buying the 2-year bond. They continue to buy the 10-year. And when it comes to bonds, the more that you buy the bond, the lower the yield goes. The more that you don't buy a bond, the higher the yield goes in order to attract new investors. So nobody's buying the 2-year in fears of short-term inflation, and they want long-term protection. So they are buying the 10-year bond. And what that does is it lets the 2-year yield increase versus the 10-year yield to the point where it is inverted. And this has been the precursor of every single recession going back to 1955. And this is also not good for bank stocks when we have an inversion. However, thankfully, that inversion is over. And bank stocks are actually one of the sectors that I'm bullish on, especially banks that have a large loan exposure as part of their business model, because as rates go up, and we know that rates are going to go up, then banks can actually start charging more for their long-term loans, right? And the reason that inversions are not good for banks is because banks usually borrow at short-term rates and lend at longer-term ones. And if shorter-term rates for the interim are higher than longer term ones, then that reverses the bank's entire business model, but it only is going to last a short term. And lastly, it is very important to keep this in mind that April is usually one of the best months for stocks. However, when we are in a midterm election cycle like we are this year, April starts reflecting a peak in the market all the way to September, meaning that we usually peak in April, and from that peak, we start a steady decline, or at least a volatile decline, from April until September, with the last 3 months of that election cycle year usually being bullish because the election is over, regardless of which way the election swings, just like in the presidential general election as well. So in summary, finally, if CPI comes in as expected around 8.5% or lower year over year, and earnings actually are surprisingly good in the face of all of these inflationary and price instability headwinds, then I could see a scenario where we get back to near all-time highs on the markets for April before peaking and likely declining due to that midterm election historical cycle, which is resiliently consistent. If inflation comes in way worse than expected and the Fed starts telegraphing way more aggressive moves as they've been doing for most of 2021 and 2022, then I don't even think we get back to all-time highs, especially if earnings are not up to par and earnings are showing a major slowdown in the mega caps. We will likely start our decline from somewhere around here. and could get into pretty ugly territory for most of the year. I don't think a recession is on the table really because unemployment is really low, historically low, and GDP is actually not bad, as well as spending and consumer sentiment. But I could see a recession on the horizon for 2023 and beyond. As a matter of fact, I think it is likely. Pay attention to the 10-year and 3-month inversion, because the 10-year, 2-year is just a start. The 10-year, 3-month is the nail in the coffin. Once this gets close to inverting, once it starts flattening, meaning going down, and gets close to inverting, then it is a better timing predictor of a recession. Anyway, traders, that is it for this video. If you get anything out of this video, leave it a big fat thumbs up just like this. Let me know in the comment section what you think of everything that I presented here. Hopefully it's concise and easy enough to understand for everybody, because at the end of the day, that is the goal of this channel. If you want access to all of our trades, including how to hedge, our market analysis, including our options trades, stocks, crypto, coaching corner, coaching questions, etc., come join a part of a very vibrant community. I think it is a great value. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.